But
that's a lot more wood.
No.
That's a tree.
No, it's not a tree. It's not a tree. Let's just say, just dance with me and let me fully flesh this out with you. Let's say you get 50 basis points in September. Again, dance with me for a second.
Got you.
25 in each of the next 2 meetings. You end the year at 350 on the upper end of the range. Maybe you need to go further in 2023, but here's what I'm saying to you, okay? You've heard me say this before. Inflation does show signs of peaking. Don't throw rotten fruit at the TV. Just look at gasoline futures, which are now back at where they were on March 1st. Take a look at inventory levels, which we know are high, and they're going to have an effect on prices. Take a look at freight costs. I can keep going, but here's the point. If inflation is coming down, and at the end of this year, you're going to be up at that 350 range, well, maybe all we've really done this year is normalize interest rates. Now, think about that. What if I changed the narrative, Scott? What if I changed it from we're combating inflation to we're normalizing interest rates? And we go into 2023. Scott, you know my thesis about supply chain onshoring. I won't trigger you by bringing it up again. But what if we go into 2023 with good earnings and we've got our interest rates at a reasonable level? And I mean reasonable in the historical sense. I can't look at 3.5% to 4% and say, oh, my God, people aren't going to borrow.
No, but you also can't say that the market deserves a great multiple on top of that. I mean, part of the argument before was rates are so low, market deserves the multiple that it gets. So now you're suggesting that even if rates go up, that it's no big deal for stocks, that everything's just great.
I think
we're just normalizing.
Yeah, I think what I'm really saying here is, this is going back to the question from 2 days ago. Very good question. Bear market rally or the real thing? I'm telling you, I think this is the real thing. Doesn't mean we can't go down another 3-4 percentage points just along the way. But really, what I keep telling you is I look into 2023 and I see a lot of that wood being chopped. Now, I don't care whether it's inflation, the Fed, midterm elections. I see a lot of debris in the rearview mirror and a pretty good-looking road ahead of us to earnings growth again.
Okay, so, Kari, let's say we believe Bullard, right? We want to believe Bullard. There's not going to be a recession, okay? That's what Bullard thinks. The Fed is still going to tighten a lot. That's what Bullard thinks. So we got a slowing economy, right? The Fed's going to tighten a lot more. We're not going to go into recession, but still, how is that great for stocks?
Well, more than half of the S&P has reported already, and the numbers were pretty good. I mean, they were much better than feared, and some were actually really good. PayPal was much better than expected. I know we'll talk about it, but I think it was surprisingly positive. And remember that the Fed was telling us that inflation was transitory. It wasn't. Much higher than expected. The Fed has told us several things about the economy. And while these are very smart people, all of them, I have huge respect for Jay Powell and all of the governors. But honestly, they didn't get it right. So if you have one say, yes, we're going to really keep hiking all through 2023, and another say, well, perhaps we're going to back off. I think the market has decided that for now, things are better than expected and that earnings were reasonably good. Inflation seems to be coming down. Interest rates have not gone up as quickly as expected. In fact, have come down from about 3.6 to 2.7. And there are shipments coming out of Ukraine. So those are positives. And the market is feeling glass half full, halfway through earnings. Things are better than expected. And the market went down 20+% on the NASDAQ, 33%, 34%. So it's time to buy some stocks at these lower prices.
So, Joe, so it's time to buy stocks. The rally's real. The hikes don't matter because the economy is strong enough to withstand it and the market has already priced in a lot. Is that why we are able to brush off a flurry of hawkish Fed speak this week?
I think we'll be able to brush off the flurry of hawkish Fed speak for a little bit longer. I do think that you have to acknowledge that this all began with a technical breakout. The break above the 50-day moving average was real. I took a position in the QQQs 2 weeks ago. I'm still long that position on those technicals. And one of the reasons why you've had follow-through is this pivot in terms of strategy. Think about growth versus value. There was this dramatic underperformance for growth relative to value to the extent of nearly 20% during the month of June for the year. We've now reversed that. Since July 1st, we've got growth outperforming by 8%. And why is growth outperforming? Growth is outperforming, and it's represented exactly in what Kari said in a lot of the earnings, because there appears to be this resiliency that's allowing for the normalization process of rates moving higher, but yet not seeing the significant earnings contraction. And I think that's very important, because what really is driving us here and extending the technical recovery is a lot of these growth and mega cap growth names in which you're finally seeing repositioning coming back in on the long side.